guys know what we're about. We're a free educational server that tries to inspire, educate, and teach you a little bit about what two guys that love to trade know about the market. In no way, shape, or form are either one of us professionals. I do not hold any licenses, neither does Kevin. I do not work for an institution. Kevin doesn't work for an institution. None of us are related in any way, shape, or form to any type of positions that we're taking. We are just making educated guesses based on historical price action and data in order to take the best trades that we can. With that being said, last week we had a very important class about everyone's favorite subject, which was risk management. Turned out that that was one of our most heavily attended classes, and it helped out a lot of people. We got a lot of great positive feedback. Prior to that market risk management class, we had given a course. We had not given a course. I'm sorry. We had done a video on what I like to call the impending doom, which was how to trade a bear market, or was something like that. I can't remember the exact title. And talk about perfect timing, because we did that recording on, I believe it was a Monday, and on Tuesday the market collapsed. And we have basically been front running this short since 2.5 weeks ago, right, Kevin?
Yeah.
Okay. And one of the things that we always talked about was understanding market rotation. And one of the reasons that Kevin and I have been successful in this bear market is because we understood where to find bullish setups in a bearish market. And what did we learn? We learned that money will move. And when money moves, it is your responsibility as a day trader, swing trader, or whatever type of trader you are, to know where the money goes. So, without further ado, let's begin. And once again, if you want this PDF, it is in the announcements. Please download it and follow what I'm reading, and I'll explain. There are no graphics or anything. This is just a lot of words. So let's go. Understanding market rotations. Understanding market sector rotations. First of all, welcome everyone, and today we're going to be diving into something that can seem a little bit mysterious for a lot of new traders, but it becomes a very, very powerful tool once you understand it. Sector rotation, if you ever wondered, happens quite a bit. It happens in different phases of the market, let it be a bull market or a bear market, but it happens a lot of times. And most of the time it happens when you least expect it if you haven't been following the markets, and it catches you off guard because suddenly you wake up and your tech stocks are completely through the roof, and stuff like utilities and safety trades start to soar, and you don't understand what's going on. So people think that this is just something random, but sector rotation isn't just market randomness. It's a predictable pattern that smart traders can use to position themselves ahead of major market moves. And currently in this market, we're moving towards bearish territory. So understanding these rotations couldn't be more timely right now, because while other people are telling you to buy the bounces on Nvidia and AMD and Tesla, and that this is going to rotate, this is just a small little market correction, we here at live sessions have been telling you that this is here to stay. It's going to affect a lot of people, and for these people that have been trading in a bull market for the past 3 years that have absolutely no idea how to trade a bear market are going to get completely screwed. And that is what's happening right now. So let's break down how money moves through the markets and why it happens. And most importantly, how you can spot these shifts before everyone else does. Because some people will be late to the game. Some people will be early to the game. And some people will just time it perfectly. And it just happens to be that these two dudes here, for some random reason, happen to have timed it perfectly. So what is sector rotation? At its core, sector rotation is the movement of money from one industry sector to another as we go through what's known as economic cycles. So investors aren't like just randomly deciding to go from one place to another. They're literally responding to the economic signals, and positioning themselves ahead of what could come. And most of the time, it's what does happen. So think of I want you to think of these cycles and the economy and the stock market in general as the seasons in a year, right? And when you start to think of things as seasons in the year, you start to say like I made this funny reference, right? You're not going to wear a winter coat in the summer. So that's exactly what ends up happening, right? People are like, wait a minute, we're seeing some shifts that are happening in the economy, and it's getting a little weird. Maybe we need to change our clothes and put on something lighter. This is exactly what ends up happening. And you wouldn't necessarily want to be in the same positions throughout the entire year, especially if there's different economic phases, right? But so it's very important to understand the economic cycles when it comes to sector rotation. People don't even understand what economic cycles are. Now, there are different individuals that will tell you that there's different names to these economic cycles, but the correct economic cycles are the early recession, the full recession, the early recovery, and the full expansion. And the thing is that these different sectors tend to outperform during each phase because the way that they're designed, these sectors, um, are based on the economic conditions of where we are in that phase of the economy. Okay, there's one of my favorite individuals to follow is Keith McCullough from Hedgeye, and he has a different way of stating these four economic cycles, which I can explain later. But the reality is that you as an individual should be understanding that these are the key economic cycles that we go through. And you need to be able to recognize where in that cycle we are. Okay? Bear market rotations, seeking safety. Now, everyone in here is aware that we're currently seeking safety. 2 weeks ago, Kevin was in the room saying, guys, there's some stuff happening. I feel kind of weird. There's not a lot of volume in the market, and I'm starting to notice certain things pop. Same thing that I said. Hey guys, there's some weird things happening. Look at Procter and Gamble. Look at the healthcare sector. We were talking about XLV, literally the healthcare sector in early February. We were talking about Merck. We were talking about Pfizer. And most recently, we were talking about General Mills. Okay. So let's talk about what's happening right now. It's a shift towards a bear market. So when investors sense trouble, in other words, there's rising interest rates, there's inflation concerns, the world is ending because there's going to be World War III because China, Russia, and North Korea are doing military exercises all together at the same time, the slowing economic growth, the investors and portfolio managers begin rotating into defensive sectors. Now, I want you to understand, defensive sectors are called defensive sectors because those particular underlines, right, or those stocks have a bigger dividend and have a lower beta. And if from the people that are here that have already been with us for a while, beta is the rate of change at which an underline moves compared to the stock market, right? So we know that Tesla is a high beta stock, but we know Procter and Gamble is not a high beta. So defensive means low beta and normally high yield. For example, Johnson and Johnson. For example, Alturia. For example, UPS. Even though UPS, I wouldn't consider it a defensive stock because during an economic recession, you would think that UPS would have a slowdown because people aren't buying things and shipping slows down, but they do pay a 5.6% dividend yield, so it is considered defensive because the price of the stock is offset by the dividend. So that should make sense. So why the flight to safety happens in bear market rallies, or I'm sorry, in bear markets, investors and traders prioritize four important things: capital preservation over growth, which we cannot stress enough, and we stress this in here all the time: capital preservation, capital preservation, capital preservation. Dividend income over capital appreciation, and I just explained that to you. People are collecting the dividend on their investment over the stock going up. Reduce volatility, which once again, lower beta, and businesses with steady demand regardless of economic conditions. So, once again, do people need General Mills? Yes, they make cereals. Are you going to stop eating cereals no matter what the economic condition is? No. Are you going to stop buying toothpaste? No. Are you going to stop, using Procter and Gamble products? No. So regardless of the economic condition, guess what? These businesses have steady demand. Okay? But it's very important that you guys understand that when there's a flight to safety, it doesn't mean that, it's not like everyone's freaking out. Oh my God, we're taking money out of the market. There's no money in the market. The advancing, descending line is telling me that everybody's exiting. No, 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 no. This isn't panic. It's just rotational repositioning based on how different businesses perform during economic contractions. That is a complicated sentence to understand. Let me make it more simple. I am an investor. I am a trader. I have a book of $100 million, which is kind of small if you're a big money guy. Right now, your money that your clients are telling you what's going on, you can't sit on cash. You have to reinvest the money. So what ends up happening is you have a rational repositioning based on how the market's going to perform based on the current cycle that we're in. Because remember, most institutional size books or desks at any given time have to not be necessarily fully vested, but most of the time they're limit long. Okay. If not, they're about 80% long and sitting on 20 cash. And I know that for a fact because when I was younger, as some of you knows, I went through the program at Wells before I walked out in 2008 before it all collapsed. Right? So, classic safety sectors and stocks. So I decided to break this down for you. You guys have this PDF in announcements where you can literally build a watch list off of this. So classic safety sectors and stocks. We have utilities. An example, NextEra Energy. I would love that you guys please pull up a chart on NextEra Energy and look how much NextEra Energy is up today. Actually, let me go ahead and do that for you. NextEra Energy is up today 5%. That's a fleet to safety. Why is it a fleet to safety? Because not only is it a utility, but it has a 2.9% dividend yield. Going back to the screen. Duke Energy, Southern Company, SO. Why? Because people need electricity and water regardless of whatever economic conditions. Consumer staples, Procter and Gamble. Believe it or not, Walmart and Costco. Why? Because people still need soap and food and toilet paper. Okay? Lots of toilet paper, And guess what? They often have pricing power even in tough times. Yes, they have pricing power. Believe it or not, they can manipulate the prices. You can walk in one day to Costco and a toilet paper from Costco. I don't even know if Costco makes generic toilet paper was $4.99 and now it's $5.99. So they're going to make money regardless, right? Healthcare stocks. Johnson & Johnson, United Health, Pfizer. Why? Because medical needs don't disappear in economic downturns. On the contrary, they increase because people start suffering from depression, anxiety, and in some cases, I hate to say it, even they consider taking their own lives And we know that because of the economic crises that happened in the dot-com bubble and even in 2008. You would see it on TV, hedge fund manager blows his head off, right? Because he couldn't handle the stress. So the healthcare sector is one of those sectors that will always, despite the downturns on the economy, will still thrive. Another example, telecommunications. I want you to open up a chart and see how much Verizon is up today. Let me go ahead and do that for you. If I'm not mistaken, Kevin is in this Verizon trade, and I hate him for it. I think Kevin was in his Verizon trade down here. Verizon was up today 1% because it did came down, but at any given point, it went all the way to 47. Gold and precious metals. A lot of people like to argue this with me. Gold and precious metals is an area where the old school used to say it was a safe haven. I still do agree with the common thought that gold is a safety haven. However, as of recent, the volatility in gold is such that sometimes it can be a bit erratic. So I don't consider it to be that safe because gold can go up or down 200 points at any given moment. And this is based on multiple other things, but still, precious metals are seen as a safety. Let's flip the script now and let's go out of a bear market rotation and let's look at a bull market rotation, which is known as chasing growth, which is what all of us love, right? Because when economic outlooks improve and a bull market takes hold, money typically flows in the opposite direction. That means that they're going out of defensive and into growth oriented sector slash high beta. And people say, well, is it safe to rotate, out of defensive and into growth at that point? When is the bottom of growth going to happen? When do you find the bottom? Well, it's not about finding the bottom. It's about understanding that there will be economic phases and shifts in the economic behavior and data that start to give you signals, right? Inside of the market internals that guess what? Things are getting a little bit easier. That maybe it's time to put on what? Risk. When we put on risk, what does that mean? We're rotating money out of defensive into offensive, right? In bull markets, investors prioritize four things. They prioritize capital appreciation over preservation. And it's very important that everyone write this down somewhere in a sticky pad, on a notepad, whatever it is called, and put it on your screen, right? When the bull market comes, it's capital appreciation over preservation because you have to put on the risk and you have to take advantage of those moments, right? You prioritize growth over income. What do I mean, growth over income? We know that defensive stocks are income producing because they yield a high rate. So if I have $1 million and I'm parking it in a 6% dividend stock, I'm making good income from the dividend. But it's probably not moving at the rate that, let's say, a Tesla would move, right? If I had $1 million in Tesla and the price goes up $20 in one day. So once again, growth over income. They prioritize businesses that benefit from economic expansion. And most importantly, higher risk tolerance for potentially higher returns. When you see a rotation from bear to bull, the high risk is on. And that's when suddenly you see those 500-point days on the NASDAQ, if not more, 1,000-point day on the Dow, 125-point day on the S&P, because the appetite for risk, the gamblers are back in the game. And it is your responsibility as a retail day trader, swing trader, investor, or whatever the hell you want to call yourself, to do what I like to say is ride the wake of the whales, right? And let's call them whales. Let's just refer to individuals with institutional size orders, right? So, what are classic bull market sectors and stocks? I mean, it doesn't take a rocket scientist to figure it out, right? Technology, Apple, Tesla, Nvidia, um, whatever, you name it, right? Why? Because business investments increase and consumer spending rises. Because if there's a bull market, that means that there's more money in the system, and that means that people are willing to spend. Consumer discretionaries. Yes, Amazon, Home Depot, and Nike. People will spend more money in non essentials. How much money have you not spent on Amazon when you're doing great on things that you don't need? I realized that I ordered 3 portable speakers and I didn't even notice that I needed 3 portable speakers. I don't know why I have 3 portable speakers. They were on sale for $9.99. I don't need 3 portable speakers. Those are the stupid things that we do when the bull markets are here and we're making money. Industrials. This is something that people will argue with me. People believe that industrials are defensive, but I disagree with them. I believe industrials are bullish because in economic expansion periods, manufacturing and construction starts to expand. Oh, but Caterpillar and all these blah blah blah, they offer a decent dividend. Yes, but when the economy is growing and suddenly everything starts to move, who benefits? Deere, because obviously farmland grows. Caterpillar, because we start to build more highways, more cities start to grow, just construction in general. And believe it or not, Boeing, because what ends up happening is that the demand for flight increases, right? Because travel starts to increase. Because when we are in a classic bull market rotation, into a bull market rotation, what do people's the first thing that people do when they make money? They like to travel. They like to do things. Nobody likes to be cooped up in their house, looking out the window, watching the Ferraris drive by and being like, "Oh my God, you know what? Whatever." You guys understand what I mean. Another argument that I get into with people, are financials not defensive? Yeah, they are because they offer a decent dividend, but they're highly impacted, right? They're very highly impacted whenever there is a bull market because there's something that happens that suddenly there's loan growth, which means that banks are lending out more money, right? And that means that they're going to make more money on interest, as opposed to when suddenly the market slowed, the economy slows down and there's lower growth. There aren't that many people looking for loans, right? And the biggest way that financial institutions make money is by lending money and collecting interest on it. That's how credit cards just make so much money. And now we talk about materials. During a bull market rotation, materials is one of the first things that pop because there's a demand for raw material because of production, right? And some of the examples of these stuff is Freeport McCormick. Uh, uh, I keep FCX and NUE on a chart at all times because when I start to see the increase of raw material, I start to say, hey, 1 second, what's going on here? Because then that leads to what? The possibility of production of the industrial market starting to increase, et cetera, et cetera. So you start to spot things. Well, JP, this looks like a lot of work. Is there an easier way? Yes, there is. You don't have to have a watch list with 50 million different stocks, right? To try to understand what market rotation is. No, life is much easier than that. I posted what I call my S&P tactical watch list in announcements. And what's inside of that tactical watch list? It's all of the SPDR ETFs. I am making life easy for everyone. Okay? This is one of the most powerful tools for monitoring sector rotations. If you watch the SPDR ETFs, you will see which is the reddest and which is the greenest. I'm going to open up my charts. Welcome to the S&P Tactical Watch List. It's every single ETF that trades for the spiders. Everything was red except for what? The UVXY, which we know is the S&P short. We know that for some reason energy was popping today, and you guys could see that because of XOM and utilities. So these were the only two green sectors today. Yes, granted, the XOP was a little bit green, but it was a bloodbath everywhere else. So why the hell would anyone want to be trying to catch along on SPY, the overall ETF, when the entire freaking spiders are red? It makes no sense. It makes no sense. The weight that's covered by the XLE and the XLU is not sufficient for there to be a pop on the S&P throughout a bear market. It's not until we start to see more of the heavier weighted spiders flip green that we suddenly can start analyzing about a possible long. Oh yeah, but look, at the end of the day there was a pop on the thing. You think that's a pop? If you waited all day for this to be your trade and you weren't in this, we got problems. Because this was the trade, not this. Sure, was that an opportunity? But it was much easier to understand what was happening in the overall market perspective when you're looking at the entire sectors and they're red. The main spider sectors ETFs, the XLK, technology, XLF, financial, XLV, healthcare, XLP, consumer staples. Everyone should look at the XLP. Everyone should be looking at consumer staples. There's not one person in here that should not have this on their watch list. XLY, consumer discretionaries. This is the second most important spider that you should be watching outside of the XLK. The XLY is so essential because consumer discretionaries are an essential tool to understanding what the hell's happening. The XLI, the XLB, the XLE, the XLU, the XLRE, and the XLC. I really don't look at the XLC, but these are the main ones. Now, granted, you probably saw my watch list and saw that there was a lot more. I've given you the watch list. It's in the announcements. Please download it. How to use the spiders to track money flow, guys. I literally just explained it to you. If you're sitting here watching on another screen the spiders or the S&P tactical list, you can start to break down where the money is rotating. Okay, guys, so the XLK selling off the technology sector, that probably means that the world is ending in the Batman sector. Guess what? The Batman sector was dying, aka the Mag 7, but I call it Batman because I added Broadcom. Okay? There's no reason for me to be in the XLK. Okay, cool. It's not that hard. Pretty obvious, right? Well, what else is in the XLK? Well, very simple. I'll teach you how you can look at what's in the XLK after we finish the presentation. But if you start to see that these spiders are heavily red, you know where the money's exiting out of. And then if you start to see stuff turn green, you know where the money's rotating into. And the beauty of it all is that all you got to do is type XLU in Google. What is heaviest weighted stocks in the XLU? And it'll give you the list. And then guess what? You can go on TradingView and you can start looking at what's the heaviest weight of the XLU. And then you can go see if that particular underline is trading heavy. So let's just do an example really quick. New window. XLU most weighted top holdings. No coincidence that the top holding today of the XLU is NextEra Energy. So let's go to Nextera Energy. And what did we discuss? NEE was up 4% today. So by just keeping an eye on the XLE and then doing a little bit of research, you could have figured out that, oh, wow, the XLE is getting some heat today. Let me go see what's inside of it. Oh, what's the top weighted stock inside of the XLE? Oh, it's NEE. Well, let me look at the setup on NEE. And boom, you were able to pick up a trade without even doing that much work. It's just by breaking it down and using a little bit of common sense. And that's the problem with a lot of traders nowadays. They're not using common sense because a lot of people, unlike everyone that's in here that comes every day or every time that we do this day in and day out, there's a lot of lazy traders. You guys aren't. Maybe this stuff is new to you and you're learning and you're going to be like, holy crap, I never thought about this. Or maybe you did. Maybe this is boring to you. Maybe it's not. But even if one person walks out of here and says, wow, I had no idea that I could do this, I feel like I'm doing my job, right? So again, we can track the money flow using the spiders. We can see the relative performance. Rather than just looking at the absolute performance of the SPY, we can look at the overall sectors. We can detect volume. We can see unusual volume. If I am looking at the spiders during these types of markets and I'm looking at the entire sectors, guess what I can do? I can say, holy shit, there's a mad amount of money flowing into this particular whatever ETF, right? And I can start to understand where the money's going because our job is to understand volume and money and rotation. Rotation sequence. Watch for typical sequence. Money usually doesn't jump directly from the most aggressive sector into the most defensive. It never does that. It does it in parts. It progressively grows into the most defensive because ain't nobody sitting there thinking that the world's collapsing from one day to another, but they start taking money out and they start testing more defensive sides, right? Because they want to dab a little bit just in case. Because you never want to be fully out of tech or high beta, because high beta is a monster, right? You can wake up tomorrow and I don't know, Elon Musk says that he invented the flying car and Tesla goes to 1 million for all I know. I don't know, but I'm just giving you an example. And then most importantly, the divergences. When a sector starts behaving differently than its peers, that's often a clue that something is changing. Kevin and I were in here telling people 3, 4, even a month and change ago, something is happening in the healthcare sector. XLV is moving. What is going on? We started to spot this. And how did we spot this? By using our S&P tactical watch list to get an idea of where money was rotating. Now, if you think that I'm being thorough and analytical here, Kevin is even worse than me. Kevin has each spider broken down with each company that's inside of that spider. How do you think this man finds the things that he finds? Because he's created a system in which he understands how to detect rotation. And that is how you thrive on these swings. Because guess what? When you find the rotation happening, you can take a trade and you could sit comfortably there for 2, 3, 4 weeks, a month or two in your options, maybe that are 3, 4, 5 months, even out a year, and know that you're on the right side because they'll start to go up slowly. And then out of nowhere, there's a rush to it. So you anticipated it, and you can do that by, once again, having that list of spiders that allow you to spot what's happening. Pro tip, and I'll show you how to do this. You set up a chart with a percentage change comparison of all the sectors so that you can see which sector is up for the year and down for the year. How do you do that? I'll make life easy for you. Let's create a new layout. Inside of that new layout, let's just open up. I'm just going to do it with one. Okay, guys? Let's say the XLK. You right click here and you change this to percentage. And then you put a line chart. Let's make this line chart, the color, white, whatever color that is. Let's say you want to see how the XLK is performing versus the XLV. You come up here and you click the compare or add symbol. And we type the XLV. And the XLV is going to be the purple. Okay? We'll put it on the daily. And then what you do is you want to slide this over so that your date is here. Right? It starts from January. And now you can see how this sector is performing, each sector is performing versus other sectors. So we know that in this case, the XLV is up 7.34% for the year versus the XLK that's down 10%. Not only that, but you could spot the divergence trade happening on January 22nd. When suddenly the XLV started losing interest, the XLK started losing interest and the XLV picked up momentum. And this is a perfect example of how you can spot a rotation in a sector shift rotation. Safety starts to pop up, high risk starts to pop down. They try to come back together because people started thinking that, guess what? Oh, people are putting more risk on, and then out of nowhere, XLV flies and XLK collapses. I'm not telling you to sit here and add every single XLV or whatever it is, or XL, whatever, XLF, line by line. You can do that if you want to, but if you're gonna lose your mind. But add your favorite sectors and understand where they're trading in comparison to tech, in comparison to high beta. Financials are break even for the year. So by using something as simple as this, you can understand what's happening. Not only can you understand what's happening, but you are able to recognize if the area of the market that you want to trade makes sense at that given time. Why are you going to trade high beta in a market that's showing you that the overall sector is getting bled out? Makes no sense. Conclusion. Understanding sector rotation isn't just academic, it's a practical skill that can significantly improve your trading results. By recognizing which economic phase we're in and which phase we're moving towards, you can position yourself ahead of major money flows rather than chasing after them. And this is such an important statement. You can position yourself ahead of major money flows rather than chasing after them. Chasing is what kills a lot of traders. The guys that position themselves well and are patient and calculating, you never hear them say that they're chasing the market. They don't chase the market. They are the market. Remember that rotations don't happen overnight. It's not like suddenly everybody exits technology and goes straight into safety, into the XLV. They do it in parts and pieces. So you can start to identify that they're testing the water in different places. The key to this success of market rotations is having a systematic way to monitor these shifts. I just gave you the systematic way of doing it. You have the watch list. You know how to create a chart with your favorite sectors. It's not that complicated. You can just have it as a tab on your trading view. Literally. You have it here on the side. Kevin laughs at me because I have the bonds open all the time. This is the bond market chart is on my screen at any given time, at all times. If I'm probably watching this chart more than I am watching the S&P. Because I like to see what the bonds are doing. Not because I recommend that you do it. It's just a me thing. It's a JP thing. But have a little tab open to the side so you understand how the overall sector is performing. As we navigate the current rotation towards more defensive positioning, remember that bear markets don't last forever. The traders who not only survive but thrive are those who adapt their strategies to changing conditions rather than fighting against them. I wrote this sentence specifically for everyone to read because guess what? I'm sick and tired of people saying, "Oh man, I'm trying to catch the bounce. Oh, here comes the bounce. Oh, it's gonna pop. It's gonna pop. Oh no." Why? Why are people so adamant on trying to catch the bounce? It's like everyone forgets that the trend is your friend, right? Like, stop trying to catch a bounce. Stop trying to be the person that thinks that they find the bottom. Because surviving these markets is very, very, very freaking hard. Believe me, I've lost hundreds of thousands of dollars. I made a lot, but I lost a lot because I wasn't mentally understanding what was going on. And I've been doing this for 20 years. I'm going to be 42 April 1st. Yes, April Fool's Day. Don't make fun of me. I hate everybody. But the guys that thrive are the guys that adapt, right? They adapt. And again, stop fighting things. Stop fighting them. I hate to say this, but Kevin is a big advocate of this. There's a lot of people that are in here that won't be around trading in the next 3 months. Because y'all went crazy trying to catch SPY calls on 0 DTEs. Because I had a feeling that it was going to go up. I had a feeling that it was going to do this. In the words of my mentor, the last time I had feelings, guess what I caught? Gonorrhea. The market is constantly telling a story through sector performances. When you learn to read this story, you find yourself making better timed entries and exits, holding positions with more confidence, and most importantly, preserving capital through real tough times so you can deploy it aggressively when the opportunity arises. Guys, right now I am sitting on 80% cash. I only have 2 running trades, Landbridge and Kratos. That's all I have running right now. And if anybody caught that Kratos trade with me for the January 2026 trade, I was the first one talking about it. I saw that there was something happening in the defensive sector, and by defensive I mean the military side of that business, right? I was able to look at it and I was like, why is there money coming into this stupid company that makes drones? I took a very, very, very educated guess on this. I put some heat on. I took leaps for 2026. The contracts were $3.38. I had no idea what the hell was happening. The only thing I knew is that there was institutional size order blocks coming in on the level 2s. The entire market, like Raytheon, Lockheed Martin, Northrop Grumman, even Hollington, which makes boats, by the way, all of that entire sector was catching a bid. I had no idea what the hell was going on. So I'm like, you know what? I'm seeing money move out into this sector. I got in. Those contracts, the January 2026 contracts on Kratos hit a high of almost 100% today. Do you think that I knew that it was going to get added into the S&P Small Cap 600? I had no clue. Do you think that I knew that it was going to win these satellite contracts? No. Did anybody know that there was this conversation that Kratos was going to get the contract for the Iron Dome that supposedly is going to be built in the United States? I read an article about it, and I saw that, and I compared it to the rotation the money that I saw coming into that sector. And sure, that added towards the confluence that I needed for the trade, but the setup was there, right? So what did I do? It was very simple. The market was telling me a story through the sectors that were performing. And when I understood what I was reading, I put on some risk. and the risk paid off. And once again, I told Kevin about this trade. And suddenly, 2 days later, all this news comes out on that company. But why was I able to find that? Because I was doing research, I was looking for rotations, I was studying, I was looking for the opportunity to put on risk and do little work and make the most money that I could. That one trade, I've been holding it for 2 weeks. It's already made more money than I'm good. I don't need to trade anymore for this week. Put it like that. So again, the market is constantly telling you a story. And during these tough times, my job, Kevin's job, and everybody who you trade with, all your friends, everyone, our jobs is to preserve capital. And that's the most important thing of this game right now. And I ended by saying this, and I want to thank everyone for joining today. Keep watching those sectors. They tell you the story, they tell you where smart money's going, and they tell you what's going to happen next. And last sentence, and then I'll switch over to the charts and any questions that anybody might have. We do this here for free, guys. We put a lot of work into this. I could be doing a shitload of other things. I could be at the gym, I could be running, I could be at the beach, even though it's raining. Kevin could be doing a bunch of other stuff, like, playing with his My Little Ponies, or whatever he does when the market's not open. But we're so passionate about this. And we hear the nightmare stories. We hear the frustration. We know people are getting hurt. And it sucks, man. It sucks. Because everybody wants everyone to thrive. Nobody in here should be rooting against anyone. Oh, I hope they're wrong. No. Like, you have a community of people, and you guys should embrace each other and talk with each other and fucking be a team. The reason that I have been so successful this year is because Kevin has become an extension of my trading. He has really helped me set my mind into a position of where I am executing to the best of my ability because I am good at one fucking thing. I am a fucking hell of a swing trader. I find things that you can't even imagine. I have a gift for that. I am horrible at day trading. I hate it. But when it comes to swing trading and understanding markets, that is my gift. And Kevin has drilled it into me. By the way, I don't mean that in the weird way that Kevin probably thinks about drilling. He's drilled it into me. Wow, that sounds horrible. That I need to execute at what I'm good at doing. And I have a piece of paper written on my desk that says, execute what you know, not what you think. I read it every morning. So guys, have your rules. Understand the markets that we're in. And most importantly, do not try to be the hero trying to catch a bottom. Do not try to be the hero trying to be a genius. It's pointless. So with that, I end it. I hope you enjoyed this presentation. And I'll move over to the questions.
JP, you talk about Finviz.
Oh, my bad. Finviz. Thank you. So guys, I've talked about this website multiple times. Finviz.com. Take a screenshot of it. Do whatever you want with it. It's possibly the single best. Great. My freaking name is on it. Good job, JP. The single best website that is available to people for free. And if you want to understand market rotation, guess what? It's right here. You go to finviz.com and you click on groups. Top rare earth stocks. I'm going to close that for now. And it shows you the performance of each sector. It gives you the daily performance, the weekly performance, the monthly performance, 3-month, half year, 1 year. How do you understand market rotation if you're not looking at the spiders? you have this website, and it tells you where the money's moving. It tells you in what position of the overall weekly performance that sector was doing. Notice that for the week, actually for the month, technology was in second. For the week, it's been in third. And for the day, it's been the last. What is it telling you? It's telling you that technology is performing weak. Last week, financials got hit. The overall performance of financials in the month hasn't been great. But look at what's slowly been creeping up in the past week. Energy and basic materials. Ignore basic materials today, but for example, you got a signal that energy was picking up in the overall week. Energy picked up. Today was a great performer. Utilities also performed well because of NEE and the safety that it gave. This website will give you an understanding of what is happening in the overall timeline of each individual sector. Cool thing about this. Oh, but okay, great. So I know what sector's in there. Remember how I told you that you can break it down to see what's inside of each sector? All you gotta do is click on it. Done. It gives you every single stock that's inside of that sector. And then you can even break it down by whatever it is that you want. You know, you could market cap, let's say it's a mega. There's only 3. If you want to break it down to a large cap, there you go. So you can break everything down by the market cap. You can even do something even better. You can do it by the average volume, right? Because you want to trade stuff that's trading over 1 million. There you go. And it not only that, but it also gives you the trend line setup, which is pretty cool. And also tells you the major SMAs that it's at, right? So you can see that there's a bottom trend line. You talk about not knowing how to draw trend lines and trying to figure out where they are. Guess what? Finviz does it for you. Zach's, where is CVS headed in March? I don't know, Zach. But here you go. Perfect trend lines are being drawn for you, and it's giving you the 20, 50, and 200 SMA. If you wanted to add more stuff, you have to pay for this, but I don't pay for it. Actually, what happens if I click on theme? Oh my God, I'm so sorry. But yeah. And this could be on any group, right? You can click on utilities. Let's go to utilities. Let's go again. Let's look at mega caps. There's nothing in the mega caps. Let's look at the large caps. It gives you the 37 mega caps. I'm sorry, large caps that are in the utility sector. And it shows you, I'm telling you, bro, Lasso Martin from State Farm. Let's see where NEE falls. NEE should be in the large cap. There it is. It gave you, look, it even drew it for you. Look at this. I can't deal with you right now. Gave you the perfect trend lines. It told you exactly where it bounced. We broke above the trend line, held it, and we went straight for the, I think this color is a 200 SMA on the daily. But this website is, oh no. This website is golden. If you don't want to use the watch list, I personally prefer the watch list because I have it open at all times. And remember, this is a website that updates at the end of the day. So the real-time data is really on the watch list as opposed to this that cycles out when the market closes. And that's it. Do you want me to go into depth with this, Kevin, or are you good with that?
I think you did pretty great. Like you already ran down basically like if you saw, let's say an influx in utilities, are you just looking at the daily or the weekly, or are you looking at a build up?
Build up.
Okay.
An accumulation pattern.
Yeah.
So is the daily building up, is the weekly building up, is the monthly? Because you can normally start to identify market trend rotations on a monthly level. Because again, you and I were looking at the XLE a month ago and we saw it start to pop a little bit because it was the bottom feeder. Remember that? And then suddenly started to pick up some momentum. It started to tick up on the list of things that were green. Remember that?
Yeah, I
You
remember.
there?
Yeah, I'm here.
Yeah, exactly. So you want to see the build up and the anticipation of it. And you want to try to get into it with the flow of money as the rotation happens. So now, if anyone has any questions, feel free to ask them, and I will do my best to answer them. And I hope that this was helpful. And hi, Tom. I'm happy to see you in the room, by the way.
Hey.
Yeah,
I have
you know what?
a
Go ahead.
question for you. Um,
Sure.
I don't know why you were hunting me down today. It's crazy.
Okay.
But
That's is it the My Little Pony comment?
no, I'm just kidding. So one thing I wanted to ask you to talk about, let's talk about right now. Where do you see rotation into? Obviously, common sense would say, lower beta. But if you were to pick out all the sectors in the S&P, which one do you see money rotating towards in the past week or two?
Healthcare.
Why?
Overall healthcare. Because it doesn't matter what happens in the overall grand scheme of it all. People's health is always going to be, something that is a priority. It doesn't matter what market cycle you're in. Pfizer, J&J, all of these companies are always going to be making money. And it's also a safe haven asset that has a little bit of decent sized beta when it comes to trading. Um, so yeah, definitely the healthcare sector for me is something that I'm keeping a very, 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 very close eye on. Obviously, utilities. Um, I've been talking about this for over a year, and I'm so happy that Tom is here because I've been saying for the past year, the rumor has had it that there's going to be an energy crisis in this country that's the type of which you've never, ever, ever, ever been able to deal with. We were having difficulty bringing the power from the west to the east, and that companies like SO and NEE were going to thrive because the demand for electricity was going to increase. I think that that's going to be a theme. It was a theme for a little bit when we were discussing data centers and the expansion of data centers in the United States. But then suddenly the conversation became that, hey, maybe we can use nat gas to power these data centers, which is why we were in that Lambridge trade a couple of months ago, right? That we did really well on. But stuff like the utility sector, definitely the healthcare sector. I'm staying away from biotech. I'm not really interested in technology right now. Even though there isn't an overall spider for it, I really like the military sector. Um, and that's just me because I do think that we're in a very, very hostile environment right now. And I'm not saying that World War III is going to happen, but even though the number one producer of GDP are government contracts to companies like Lockheed and Raytheon. And with all of this cutting, our GDP has flipped negative, and I don't see the earnings potential in these companies. I do see investors fleeing to it because of what could happen if there was another situation where there was a global war that could affect supply chains, and if not, the overall you know stability of the globe itself. Does that make sense?
Yeah, that makes sense.
Mhm.
Um, I had a question to ask you before I was gonna ask the people's questions. So you prefer, not prefer, but you're seeing money rotate into XLV instead of, let's say, consumer staples?
I mean, we saw that the other day, right? We saw this with the healthcare sector, right? When we saw Johnson and Johnson
Yeah.
start to pop, we saw Merck, we saw AbbVie. I mean, need I say more?
Oh, AMGN is technically healthcare, isn't it?
You know?
I forgot.
So, I mean, I just like it as an overall sector more.
Hey,
I know that,
I
yeah.
was just gonna say, like, it was funny because I got fun of earlier in the year, that healthcare was gonna be one of the bigger themes heading into 2025. Well,
We
look
were
at us.
talking about it here.
Yeah, exactly. The biggest giveaway was when Nancy Pelosi got into those, what was it, the TEM calls or
Yeah,
T? Yeah,
yeah.
yeah.
You
Um,
know, I still believe that nat gas has more room up. Um, I mean, Tom would be better suited to talk about that, but I have been seeing a strange little, signal that I've been getting on Nat Gas, and I spoke to Tom about this, and I said, Tom, something is going on in Nat Gas because these boys are throwing money at it, and and they're trading the Nat Gas futures like if it was, I don't know, but I think Nat Gas might start to catch a bid. But yeah, healthcare, man. I think healthcare is gonna do great. I really do. I really do.
I'm all for it, bro. I've been long on Eli Lilly, Merck, of course, as you know. Um, I want to get into a good entry of UNH, but I kind of hate that company to death. So I don't know. We'll see. But so I'm gonna ask the questions that people asked here, and I
Sure.
was actually finally able to get that Twitter stream up. So that's great. So question, and you guys just start asking your questions about sector rotation because you definitely want to make sure you understand this topic to the extent where you're comfortable in understanding it yourself. But let's see. If financials are rotating down, then can we see Robinhood stock, which is Hood, down to
Ooh,
$30 as a swing
I can't.
trade out 45 days? And what timeline should swings usually stick to?
I can't tell you what timelines you should hold your swings onto because that's not something that I'm not necessarily allowed, but it's not something that I can tell you. I mean, I love Robinhood as an overall company now. It took me a long time to get to appreciate it. I do think that if they start to adopt this day trading software that's going to compete with Thinkorswim and E-Trade Pro, that this company is going to be the top of the line when it comes for, the retail trader that's trying to keep it simple, clean, and compact. I have a key level at 34.17. I still have the 200 SMA down here. Let me just turn off this EMA. And again, you can even ask Kevin. Kevin's been using the SMAs lately. And he's
Yeah.
he's been like he's like, "Hey, yo, what's going on here?" Because everything is playing perfectly off these majors. I would look at $30 before I would go long, see if it holds. Yeah, everyone's gonna tell you that that it's entering oversold. There's still a little level down here on the RSI, which is around the 24 range. I would like to see I would like to see Hood come to the $30 range, see what it does, retest the 200 EMA, and then potentially take longs. Um, I've been talking to Kevin on a personal level about taking calls for January 2026 on some stuff. Um, I like Hood. I just want to see how it does right now. It's getting the shit kicked out of it because of this whole failed crypto summit that even Tom called me and was like, that was the worst thing I've ever seen in my life. And I have to agree with him because now I'm an XRP bag holder. Does anybody want to buy my XRP, please? And yeah, um, 45 days out, I think, in my opinion, I'm not very keen on taking that trade. I want confirmation before I take any bullish setups, unless the bullish setup is already there and it's something that I feel and I see that really has the potential to go.
So if you were to, so, all right, obviously not a financial advisor. But if you were looking at hood puts, would you look at hood puts to begin with, even if you have a target down at 30, or would you rather wait for calls?
I'd rather wait for calls.
Why?
Because I do believe that, like in every bear market rally, there are going to be, moments of happiness and euphoria where things might pop. And we have taken a massive beating on it. It's down 20%. And anyone would tell you something that gets beat up like this, you just close your eyes and buy it and average down if it goes to 30. I don't have that type of capital to do that. And, my mentor always said, I can't remember what year it was, but one of the best traders on Wall Street by the name of Paul Belika came into the office one day and he said, "You're never going to get a number like this. Buy the shit out of everything." And the next day, the market went to recovered its entire loss, and it was like in the 88 or 89, whatever it was. But I don't have the kind of capital to be averaging down right now. So yeah, I would wait till I get confirmation for longs. That's me. You can do whatever the hell you want. I'm not telling you what to do. But me, I'm not ready.
All right.
Also,
Mhm.
also, and I gotta say this because I'm very grateful that Tom is here. Tom is a huge advocate of this as well as Kevin. I'm not trying to get ahead of anything. I'm just gonna wait till I get the signal to go long. That way, I don't have to be stressing out the whole time.
All right. I'll go to the next question here. JP said something about XLK. Can't remember exactly what it was, but he said he will talk about it later. What was that, JP?
That's a good question. I can't remember.
The old person memory is kind of kicking in, isn't it?
I can't remember.
Dinosaur memory. What to do? What to do? Bob, do you have any hints at what he was talking about? Or does anyone else?
I'm trying to think what the hell I was talking about the XLK. I have no idea.
Were you talking about
Honestly,
what it was reaching
I went
down
on a rant.
to, or
I can't remember. If I remember, I'll type it out and send it as a message.
what the heck are those tiny boxes on your chart? I have
What
numbers in
tiny
them.
bucks?
What? No, what are those label things?
Oh, these are just areas for pivots on price that I just keep up.
Oh,
I've been
okay,
wanting. I don't sometimes when I don't want to draw the levels, I just want to have these marked off.
gotcha. Line chart to compare sectors. Didn't you already do that for the
Yes,
XLK? Okay.
yes.
Oh, here I have a question for you before I move on to the other questions. Why is it important to look at the line chart for the sectors versus the candles?
It's so that you can see the percentage.
Okay.
It's easier on the eyes.
Oh, all right, let's see.
It's just much easier. It's just much easier on the eyes.
Someone said, I work for the military. We're at the gates of conflict. Trade wars are the stick that pokes the bears. Much more I can't say. Yeah, wasn't that true, man? Um, just trying to beat theta. Okay, so this is just my opinion on swing trades. If I fear that theta is going to be a factor in my swing trade, I'm personally always looking out to 30 to 45 days out. But you also have to kind of factor in how volatile the stock is. The more volatile the stock is, the theory is you'd want to go farther out. But the less volatile it is, you can technically be okay. Again, these are my opinions, going a little closer. So what I mean by that, let's say Coca-Cola. You don't necessarily have to go 45 days out because the volatility is very low on that compared to a stock like Hood, which has high volatility, and IV crushes and theta are going to be much more of a factor. So because of that, for a Hood trade, whether it's on the put side or the call side, I personally would like looking 30 to 45 days out. Versus for Coca-Cola, I'm fine looking 21 to 30 days out. Hopefully that kind of answers that question. And cash secured puts are pretty great for stocks you love. Absolutely. I do that on like a daily basis. All right, let's see. I'm just let me see if you guys have any questions related to this topic. If not, then we can move on to the other topic or any other topic. Let's see. Hey guys, don't know if this is asked, but how to know, JP, how to know what sector the stock market is currently in?
I don't understand what you're saying.
Okay, so I'll dissect the question. I'll kind of somewhat answer it.
Are you asking me what market cycle we're in?
Yeah, there you go. Thank you.
Okay. Well, what market cycle do you think we're currently in? Do you think that we're in a full recession? Do you think that we're in an early recession?
Early.
There you go. So currently, in my opinion, we're in an early market. We're in an early market recession cycle, right? We're nowhere near a full recession, and we're nowhere, not even close to a recovery, right? So I believe that we are in an early recession. Um, People will argue this. People will say we're in a full blown recession. People will even say that we're not even in a recession. I believe that we're in an early recession. Um,
How can you tell?
and what do you mean? How can we tell?
No, it was a
How can
question.
we
How can you
tell?
tell that we? How can you tell personally that we're in a recession or early stage of recession?
How can I tell that we're in an early state of recession? We have a declining housing market. We have an excess of houses for sale in Palm Beach, which far exceed the amount that is normal in any capacity. We have inflation that has returned. We have rate cuts that are not happening anytime soon. We have less spending happening. We have higher debt. We have a higher debt issuance. We have less mortgages being asked for. We have an uptick in the 30, 60, 90-day delinquencies, both in auto loans, home loans. We have an uptick in the first 30 cycle of foreclosures. And most importantly, we have a market sell off, which is not even a correction, it's an exit to liquidity and safety. People are scared. Not to mention, unemployment is probably going to tick up. You have an enormous amount of federal workers that have been basically displaced. You're going to have a massive uptick on the unemployment rate. You're going to have a huge uptick if they're not hiding the numbers, which I don't doubt at this point because it's just that bad. The amount of jolts, okay? I don't think there's that many job openings. And we're going to have a continuing jobless claims that's probably going to be above 1.9 million, if not into the 2.1 and 2.2. So what ends up happening when there's less people working and you have an uptick in unemployment, people aren't spending money, the price of things are going up, inflation doesn't go down, it's on the contrary going up, and everyone is terrified the country enters into a recession. Not to mention you're operating on a negative GDP according to the Atlanta Fed. That's not cool. So there are your market recession signals.
Let's say if you don't have the 5 brain cells JP has and you have the 2 brain cells that I have, just the fact that when you look at growth stocks tumbling down at a significant rate, usually is a start of when you would have question marks. And especially when people have had question marks about how overvalued the market is as a whole the past year, if you think about it, then that should kind of tell you, right? Because, um, how many times have you heard or thought to yourself, oh, this NVIDIA earnings is really important? You've thought that for 4 consecutive NVIDIA earnings. That is almost a year. So if you have to keep thinking, or if people are telling, hey, this NVIDIA earnings is very important, that means everything else is actually pretty weak, and the only thing that's keeping us afloat is NVIDIA. And we've talked about it multiple times, but one of the reasons why we're in a very dangerous state is because during the pandemic, obviously you guys know this, the stimulus checks, people flooded the markets with money, and that's why we had a significant rally afterwards. So we have stimulus money still in the market right now. Also, additional to that, during the pandemic and after the pandemic, there was a lot of, I've said this many times, there was a lot of foreign central banks that invested a lot of money into the US stock market, right? So at any given time, if these countries need to, for some reason, liquidate their positions, that is going to set off a series of very strong downturns in the market. For example, the China has been selling off the U.S. debt. They're unloading
Treasury,
their positions. What'd you say?
treasuries.
Treasuries. Thank you. So when you have all these factors working up against you, and we were in the bull market, let's say last year, then you have to realize if only a few things are keeping us afloat, that means there's nothing down here that's supporting us. So when you have nothing down there supporting you, the fall is pretty big, which if you guys remember 2008, yes, we had a housing crisis, but what made it worse is the stock market tumbled because it had nothing down there, right? Go back to dot-com bubble. How is the dot-com bubble very similar to today? Well, because the internet was blowing up and there was a lot of companies on the stock market at that time that were on the stock market, but they didn't make any money. But people kept on buying into it, and even though they made no revenue, these stocks were just flying. How could you relate that to today? What is the biggest theme today? It's not the internet. No, it's freaking AI. How many AI companies do you see that are on the stock market right now that make no revenue, that are not really huge, that is just headlines that's kind of getting them, the the bid, right? And it's just exploding to the upside. And how many of those do you see right now that are actually getting killed? So you could compare the prior recessions and the prior stock market crashes to figure out, because everything's not going to be the same. Our crash that we have, if we potentially have a crash, what could possibly be bigger or smaller compared to the previous crashes? I personally think it's going to be a little bit bigger. But I feel like even though it's going to be bigger, it's going to be a lot more controlled because there's a lot more money involved than the previous market crashes. That could work in our favor. That can also work against our favor. So to answer your question, that's how you figure out when you see a growth sector, which is, for example, tech, which JP talked about, which is XLK, losing a significant amount of value. That could tell you, okay, stock market crash is coming, and then not every stock market crash relates or causes a recession. So you have to ask yourself what causes a recession, and you have to think, okay, inflation, other factors, so on and so forth. And if those are already high and you're getting a stock market crash, that's what gives you a little bit more confidence in thinking, hey, a recession's going to happen. Again, not the greatest thing, right? We don't want recession. But JP, if you don't mind, actually, if you can go to RSP, because I want to show this also as an indication for figuring out the market health. JP.
Delta Airlines is down 13%. United Airlines is down 12%. American Airlines is down almost 10%. Airbnb is down almost 5%. All of these travel stocks are down almost 10% after Delta has issued and slashed their guidance, citing sinking consumer confidence. Oh my God.
Wait, JP, could you look at RSP? Am I muted?
No, I'm here.
Yeah, so if you see from 2024, RSP has made a lower high. That's not healthy. So, and that's technically an H pattern. As ugly as it is, it looks like the H pattern's cousin. But that's an H pattern for you. And if we lose that, that is going to show you how unhealthy the market is because, majority of the holdings in the S&P 500 are in fact bearish instead of bullish. So, there's that.
Yeah, there's that. And then there's Delta Airlines that's down 12.
Um,
Oh my
right.
God.
So Carlos, actually, when we post this recording, you will actually figure out how to figure out this stuff. So you no longer will be a person who doesn't have knowledge. So watch the recording. Once I post it, I'll post it not today. I don't know if I'm gonna post it tomorrow. Probably Thursday. Wait, was today Monday? So Tuesday, Wednesday. So when I post on Wednesday, maybe I'll post it tomorrow. I'll see. It might answer your question, and then if you still have that question, if we have a live session on Thursday, you can ask it again. Just make sure to write it down, and we'll answer. But let me go to the other questions here. JP, could you tell me what the SMA? Someone was asking what the SMA ranges are that you
I'm
have on your
sorry, I
chart.
don't understand what you mean by the SMA
Like
ranges.
which SMAs you have, which moving averages.
The 10, the 20, the 50, the 100, and the 200 for the dailies.
Okay, cool. Again, I'm gonna ask the questions that relate to the topic, and then eventually I'll get to the topic questions that relate to this topic. Um, The difference between early and full difference is every stock market crash and every recession happens in two waves. So the first wave is not the full recession or full stock market crash. We'll just refer to it as a stock market crash. It happens in two waves. You would see it on the Elliott correction wave theory. It's A, B, C. So we're in the A phase. You could say we're in the A phase. We're going to get one small rally after that. That'll probably last a week or two. And then after that, that's when we get the significant move down, which could last for a series of months or a month, right? It really depends. We're in, even though it's not new territory, we're technically in new territory. Again, you cannot ever expect that what we're going through right now is full. It's not even full. It's early. You can't think just because this is bad that it's early, right? I don't know if you're thinking that, but yeah, it's pretty bad now, and I can tell you, in my opinion, I don't think this is anywhere close to full. This would be the early stages of a stock market crash. Let's see. Something Jay Powell has said is if you believe the crash will be bigger than 2008, then you believe the Fed and the US government have learned nothing since then. We'll see. We'll see who's right and wrong on that statement, right? What happened to the slow landing that Jay Powell promised? Well, I mean, I can't really talk about how well he's doing his job because I don't know too much details about that, but you have to also realize one job he does have is making sure that the US economy does not start panicking. So there is that. Remember that. Because back in 2007 and 2008, the Federal Reserve president, right? That's what their title is. He kept on saying things were fine. So that's also what their other job. They have to regulate, or whatever the proper term is, make sure everything is going correctly in the economy. But their second job is to make sure people don't panic. So sometimes they will have to say things that will make people not panic. Yeah, thank you, JP. Paul Volcker. All right, let's see.
It wasn't Paul Volcker. It was what was his name? Hank Paulson.
Hank Paulson. Okay, thank you. How
Oh,
long?
he lives in Palm Beach, by the way.
Of course, every old guy lives there, including you. You know what's new. How long do you think the market rotation will last based on your experience?
I have no answer for that. I can't tell you that. I don't know. I don't know anything about how long it's gonna last. You know? I mean, these are scary times. Things could get really, really bad. This is not even bad. This is not bad. This is not bad. This is not bad at all. This is not bad. Bad is the S&P coming all the way down to 4,900. You know? Does it have? I mean, you got to remember, you have the plunge protection team now, right? So, do we really think that the market is gonna, say somewhere there? I mean, what is that? That's a 20% correction on the stock market. I mean, that's terrifying from all-time highs. I don't know, man. I don't know how long it's gonna last. I think things are gonna get worse. But how long does that rotation last? I can't tell you. I can't tell you. I can only tell you this. I do believe that there's a lot of stuff that's overvalued. And when Nvidia is trading at 400 times price to earnings, we have a problem. So that's all I can tell you. The only thing that I would say to someone is, play smart, play smart, play tactical, take your wins when you see them, and don't try to big brain anything. Just be clever. That's all I can say.
Next question. Could you go over how we can confirm which sector it is rotating to? So, Could you just go over how you can confirm which sector is gaining
You
traction?
come over here, yeah, you come over here to the spiders, the S&P tactical that I have, and you just start to see which one's catching a bid, right? So in this case, the XLU is catching a bid, and you start to see, oh, okay, listen, it's having consistent days of upticks. Where is it trading right now? Does it still have more room up? Do I have any levels here that are preventing it from continuing to go up? It looks like there might continue to be a rotation here. It might try to go for this $80 mark. Okay, I still think that there's more room on the XLU. So you click on each individual sector and you start seeing the chart pattern and try to recognize if there's any upticks, if there's any bottoms, any double bottoms, if there's any type of particular directional move that's causing a continuation in that particular sector, right? Same thing with the market rotation. So right here, perfect example, big sell off, probably broke through a level down here, continuing sell off, had a little bit of a relief, another big sell off, right? The trend is your friend. End of story. And you just keep it like that. Keep it simple. Just look for the continuation of certain sectors moving up. If you see that the XLU is up today 1.1%, make a note of that. And then tomorrow, see where it's trading. Is it going to reject at this level up here? Or is it going to try to push up there? Are there a lot of block orders up here? Are there sellers up here at the 79.75? You go to the options premium and you see if there's more calls than there are puts. Are they trying to push this higher? You just have to kind of keep an eye on everything and then go to Finviz, which I talked about earlier, and start recognizing if things are doing what they're supposed to be doing. And that's it. You don't overcomplicate it, you don't undercomplicate it, you just keep an eye on everything.
How many interest rate cuts do you think will be made this year?
None.
Why?
Zero.
Why do you think that?
Absolutely zero. Because until the labor market completely collapses, which is not collapsing, there's no reason to cut interest rates. Powell has said it, and everyone keeps saying the economy is fine. Everything is fine. And you have to believe what they're telling you. If the cat is yellow, or if there's an orange cat in the room, there's an orange cat in the room. It's not black. It's not white. It's freaking orange. They're telling you everything is fine. The labor market seems to be fine. And apparently 3.9 to 4.2 unemployment is healthy in this country. Everything is fine. So why are we going to cut rates? Well, you really think that we're ever going to have 0.1% interest rates or 1% interest rate or 2 or even 3% interest rates in this world ever again? Please. Welcome to the new norm. 5 to 8%, maybe even 10%. Literally. In the 80s and even in the 90s, interest rates were above 10%, right? Our parents, the ones that were fortunate enough to purchase a home, um, uh, they were paying, I think, at upwards of 16, 17, even 18%. So I don't think there's going to be any interest rate cut. Unless we have a complete collapse of the labor market and unemployment goes through the roof, which it might. But then again, Powell is telling you everything is fine, everything is fine, everything is fine. So you have to believe what they're telling you. Give me
Uh,
one reason to cut. Give me one reason to cut rates right now. When consumer debt is at an all-time high, you're gonna give more credit to Stevie, who has X amount of credit cards and has doesn't have a 60/40 LTD, that's loan to debt ratio, right? And is in debt to his ass so that he can go buy a house. Why? It's gonna foreclose. I think we are going to enter one of the darkest periods ever seen. And I
in your
lived through the
opinion.
dot com. In my opinion, we lived through the dot com. I lived through the dot com bubble. It was graduated from middle school in 20. No, I graduated from high school in 2001. Graduated from middle school in 19. When did I graduate? Yeah, 2001. Yeah. I witnessed the dot-com bubble. I was here for 2008. I witnessed it happen in front of my face. I was living in Brickell Key in one of the most incredible exclusive areas of Miami. I lived on an island where the most expensive high risers are right now in Miami. I saw that collapse happen in front of me. I was here for September 11. I was here for the flash crash. I think that this is going to be, in my opinion, one of the worst because of the 30% inflation that we've had since 2020 to now. Because even though they're telling you there's been a 2% inflation year over year, whatever the hell they want to tell you, how much has inflation gone up since 2020? Let's see, let's find out. How much has inflation increased since 2020? Approximately 23%. Are you making 23% more income? I'll tell you who is. The guys in the tech sector, the guys in the military sector, cybersecurity, smart people that got into AI ahead of the game. But your average Joe Schmo that's in strategic sales and business development, that guy is making 23% more. Let's say he was making $100,000 a year. Is he now making $123,000? No. And I can assure you that in certain parts of the country, 23% inflation is a lot higher. Here in Palm Beach, it definitely ain't 23%. It's more like fucking 35%. And I hate to sound like a pretentious putz, but reserving a tennis court now costs me $30. It used to cost me $15. What the hell? Going out and playing golf right now at a shitty golf course in Palm Beach, like Palm Beach National, is costing a couple $100 to play golf. Those are high-end things, right? Every average restaurant in here in my vicinity has increased at least 15% their fees. And I know that because I only drink Stella in a bottle. And if I want a Stella, I go somewhere and it used to cost $7. Now it's $8.50. Why is it $1.50 more? That makes a lot of difference. So, yeah. My house has depreciated in value close to 10% in less than 6 months from its high.
Wait. Whoa. Did not hear that. Wait, seriously?
What?
It has depreciated 10% in the past six
Yeah,
months? Wow.
yeah, yeah.
I need to look at my
My
real
house
estate
at
now.
its my house at its peak was anywhere between 780 to 820. Right now on market, based on comparables, 680 to 690. And they're assuming that it's remodeled.
Crazy.
And I'm in one of the most demand areas in the country. Palm Beach Gardens across from Juno Beach, next to Jupiter, across from Donald Trump, Trump International, the Bears Club, Michael Jordan's restaurants, and Michael Jordan's house. And DJ Khaled lives across the street.
The funny thing is,
DJ Khaled lives across the street. Yeah, I know.
no, uh, Joe Bosco said, I'm gonna call you Joe Bosco. Joe Bosco said, times are different now. We are more informed and more aware. You would be very surprised at how greed leads to repeated dumb mistakes. We see it in our trading, and we'll definitely see it in the economy. Money ruins a lot of things.
Oh yeah,
Greed ruins a lot of things. The same
including
things,
people.
yeah. So the same things you see going on with your trading is the same thing that goes on with the economy. Um, you know, all these banks and all these foreign central banks were jacked to the tits in buying, buying, and buying and buying. When they
Jack
are, yeah,
Jack.
When they're gonna realize like, ah, okay, all right, this is too much, they'll start unloading, and we will be the ones who are gonna face the burden of that. So we can never think, even though history is there for everyone to see, we can never expect it to actually be, you know, listened to or learned from. Because if we're doing the same thing in our trading, what makes you think people who are getting paid on the side by different sectors, different companies to keep on doing this and keep on doing that will think, oh, let me put America first? So remember that. You can't ever think that people will make informed decisions because of the history.
Dude, we're peasants. We're the peasants. You think they care? They're making money on either side, on both sides. They don't care. We're peasants.
And definitely
So
we know Trump is profiting off of this volatility. I'm not surprised if he is.
my orange king.
Oh God, shut up. Do you think that market rotation is usually caused by them to get better prices, or is it the process that occurs spontaneously?
Do I think that they're doing this so they can get better prices on Nvidia? No, I think they're doing this because they need to park their money in safety and collect income. Because what the hell are they going to do with all that money? They're not going to deposit into their bank account to collect what 3.25% interest rate on their CD, or what are they going to buy bonds and sit there at a 2-10 year? No, they're going to deposit it into something that has volatility, a little bit of volatility, make the money on the income by the dividend, and then get the money on the uptick. It's a win-win for them. And they're not risking the fact that Tesla might drop another $1 million and trade at negative. Futures are down again. Great. All right. Any more questions?
Yeah, sorry, I was just give me 1 second. All right, let's see. Oh yeah, one of our viewers lives in West Palm Beach.
Oh, really?
Yeah.
Nice. Send me a message. We'll link up. We'll go have a drink. Are you in West Palm Beach or Palm Beach Gardens? Where?
Oh, great. Now he's gonna take pictures of you while you're changing in the shower. Why would I say that? So weird. Okay, let me answer the other questions. And I'm gonna ask the questions that are
Send me a message if you're in Palm Beach. In Palm Beach, Jupiter, anywhere, send me a message. We'll grab a drink. We'll go somewhere. We'll go to like River. We'll go to the old brick tops or something. Or River House. I don't know. Somewhere. We'll go harass some old ladies.
Do you think SPY can fill the gap at 580 before it collapses further?
I don't know. I don't
It,
know I don't know what it wants to do. It looks like
where's
an
the gap
erratic.
at 580? Hold on. Where's the gap at 580? Oh, is it? Wait,
Talking
did,
about this gap up here.
didn't that already fill?
Hey, that's already been filled. Yeah.
Yeah, that gap's already filled actually. So if you're asking if the price will go up to there, I mean, uh, JP, could you go to your patterns tool set on the left side?
Oh no. What do you,
Just
okay. Oh, I thought you wanted me to use the all chart patterns indicator.
no, no.
That's
So go
garbage.
to the
Okay.
left-hand side, the patterns. No.
What am I doing? Uh-huh.
Above, yep. And press ABC correction wave. Take your mouse and
Where's
take it
that?
slowly to down, ABC. It says ABC. Elliott correction wave, ABC in
Right, okay.
parentheses. Yeah, there you
Sure.
go. So if you draw it from the top,
Uh-huh.
right, and just draw it, let's say, down to where it is right now. Usually, and then click on it, usually next point is up. So what you get here in a correction, I'm not saying it's going to bounce now, is you're going to get usually a dead cat bounce, because remember, dead cat bounce is different than a short cover, which will go to the upside, and then the C wave, as exactly as JP is drawing it right now, is going to be when you're in the full extent of the recession, because that, as we talked about in the bearish market video, is where most people lose a lot of money. So yes, of course, we are going to expect a dead cat bounce whether it be in the near-term future or somewhere from now, that is going to take place that is going to cause SPY to rally and all the tech sector to rally. But that is going to be followed most likely by an impulse wave to the downside. So will SPY reach back to 580 on that B wave? Probably, maybe. But it depends when that bounce happens, right? You could see here that JP literally on the dot nailed the B wave where it would go up to the 50%.
I totally guessed that, by the
Yeah,
way.
the 50
Dude, that
ratio.
is freaking weird.
Yeah, dude. So I mean, usually B waves would retrace to the 50 to the 61. No, actually 50 to 38 ratio. So if there were, let's just say hypothetically, tomorrow starts a dead cat bounce to the upside, then yes, okay, you could easily see SPY go to 580. But if it keeps seeping down, the level to which SPY could retrace up to before continuing down is going to be lowered substantially. So keep that in mind. All right. Let's see. What other questions? Oh, you're going to love this. Tesla. Go to Tesla. Could you guys analyze Tesla's action today? It's been oversold and broke through multiple supports. Do you think it has bottomed? JP?
No.
Yeah, no, I don't think it's bottomed either. For example, on my long-term port, I am simply slowly and very, for lack of a better word, smallly, what's the word? Reduced, small, what's it? I'm basically adding a very small amount of shares at these levels, but I am not in no way, shape, or form think this is bottomed out.
187.
Yeah, so just like JP said here, we talked about like weeks ago or months ago on live session how my personal target for Tesla was 250, 286. I thought it would reach 250, 286 and bounce from there. It broke way past it. So now that we're past 256, 252, 56, it might reach 187, which is kind of the bottom of the range. Could we see a small bounce in between? Possibly. That's why I'm adding a little amount of shares here and there, especially on a day where Tesla's down 15%. But I'm talking like 2.4% of my portfolio of my long term, which is such a small amount, is in Tesla. So that shows you how confident I am about it being bottomed out, which is little to none. So just because something's been oversold does not theoretically mean that it's going to be bought back up. That is a bad habit that a lot of people, and I don't blame you, a lot of people have learned during a bull market. So I know you're just asking as a question. It's nothing. I'm not trying to blame you for anything at all whatsoever. I'm just saying, thinking that it's bottomed out is a little bit premature. Maybe what you want to be asking is, if I have a decent sized portfolio, do I want to maybe start sizing a small position of Tesla here? So then 2 years down the line, I could see it past these levels that I'm adding at. Yeah. All right. We're gonna speed through this. So most stocks are sitting at 90 to 100% IV percentile. Thank you so much for looking at that number because that is so important. Seems selling options makes more sense now. Absolutely. That is why I'm first of all not even buying that many stocks in high beta. I'm only buying in low beta because all the high beta stocks are all 100 to 90% IV percentile. That is insane. That is why actually I've been personally taking on the back end a lot more credit spread trades versus naked option trades. Because as I talked about in the bearish market, I told you guys, you can't tell me I didn't warn you. I told you guys that the IV will increase. And look at us now. From that video, the IV has increased 20 to 60% on whatever specific stock you're looking at, which has caused the IV percentile to increase from most stocks from about 30% to 80 to 90%. Tesla reached 100% IV percentile again for the second time in the past 2 weeks. Actually, no, third. So, selling options, if you're able to do that, or if you know about it, which again, if you guys don't know about credit spreads, you can watch our video on it, can seem like it's more of a uh can seem like it's more of a better option versus buying naked options. Sorry, 1 second. I'm replying to a text. Okay. Let's see. How do you guys think about the bear market we're in? I mean, this was expected, and I think it's gonna last much longer. We're already planned for this, so at least, I mean, I'm sorry if I'm gonna be rude when I say this. At least I'm planned for this. I know JP is. Some of you guys are as well. So, I mean, it's expected, so I have no, um, personal feelings about it. Sorry, 1 second. All right, cool. Sorry about that. All right, let's see. Don't know if it's been asked. Yeah, we already answered that. In your opinion, which platform is the best one? Yeah. Dude, I've been asked this question so many times. Let me finish your question. If I had $10,000 to trade, what position size per trade do you think I could open? Well, first of all, for your first question, my answer is always going to be Thinkorswim. And again, I'm not sponsored by them, but they're just the greatest all-around platform. The only time Thinkorswim would not make sense is, well, it's not that it wouldn't make sense, but if you're just like a long-term trader, or you just buy leaps, or you do a dividend portfolio, Thinkorswim is still great, but you can probably shift over to Robinhood since your entries don't need to be precise. But if you're looking at swing trading and day trading, you do want to probably look at options such as Thinkorswim, E-Trade, Tasty Trades, Interactive Brokers, Fidelity. These are options you want to look at. As to your second questions about the $10,000, if you were to trade, we did have a risk management session on Saturday and on last Thursday. We can't directly answer that question for you because there are questions you would have to think to yourself that would help you answer that question. And it's actually really easy to figure out that answer for that question. If you figure out that you can take on risk, then maybe, actually, I'm not even going to say any more further. If you haven't watched the risk management video, which we uploaded today, pretty important video that you can watch. A lot of information on there. So yeah. Let's see. Bigger compared to 2019? Yeah, absolutely. We answered that. Oh, JP, are you on here, or are you
Yeah, I'm here.
So Betty asked, now a lot of people are talking about the 300 moving average as the stock market has been dropping so much. Do we need to add it to the MA moving
I
averages?
haven't heard
No.
anybody talk about the 300-day moving average in any capacity.
Yeah, personally,
I've
neither have I. I think the 200 moving average is just enough because that is what primarily, institutions look at. So,
Yeah, I've never heard about the 300. I heard about the 150, but never the 300. So I wouldn't be able to tell you that.
Can I chime in on that one?
Yeah.
no.
All right.
No, I'm kidding, dude. Yeah, go ahead.
When you start seeing people start changing the indicators that they use, so if they use something 99% of the time, and then the market goes a different direction and they start trying to literally move the goalposts, right? It's usually not a sign of strategy. It's usually just coping.
Yeah, that's
That's
very
usually
true.
what that is.
The 200 moving, thanks, Tom. The 200 moving average is just a globally exceptionally known or understood as the biggest moving average you can look at. It's for, not only day trading, swing trading, but it's also for long-term investing. So similar to patterns, why do patterns work out well? Because, majority of people can view it understand it, and all get into the same thing, right? You want to trade on the collective, not on the minority. So the minority in this case would be the 300, and the majority in this case would be the 200. So you would not want to theoretically start looking at things that are not globally recognized, such as the 300 moving average. 200, in my personal opinion, is just much better. That's the most I would ever go. JP, what are your thoughts about copper futures or SCCO?
I don't touch copper. That's a Tom question. I don't go near it. I wouldn't be able to give you my opinion on it. The only thing that I trade on that hemisphere is aluminum, and I traded via Alcoa options. But I don't want to give you my opinion on anything that's copper related. I'm ignorant to that subject.
Tom, oh my gosh, my voice is cracking up. Sorry, I'm fasting. So, Tom, do you have a quick answer on the copper futures thing or no?
Not a quick one.
How long?
Like half hour.
Oh God, okay. Never mind. Maybe we could
Not
do,
now.
yeah. All right. Let's move on. Sorry about that. Wish we could answer, but you do have sources such as, yeah, yeah. We'll move on. We'll talk about it another time. Futures and all other, rare metal earths. All right, let's see. Where do you think will likely bounce if it does bounce? I think you're talking about SPY. Let me see.
Why is everyone looking for a bounce?
Unfortunately, people always look for bounces. All right. If you're talking about a long-term bounce, SPY probably below 450. That's where I see it as a long-term bounce. If I were to guess right now. Oh, referring to the question on Tesla. My bad. Sorry, my bad. Tesla. 170, probably. That's where I could be like, okay, this is where buyers definitely would be. Next level is $20. I'm just kidding. 170 would be my guess. If you, for example, and I'll post an image here on the main chat. If you go to, because you need to look at to figuring out where the extent of a strong bearish impulse move would extend to, you need to look at the weekly. You can't even just look at the daily. Daily is just not enough. So if you look at the main chat, I posted an image there. So I'll move this over here so you guys can also see. The weekly on Tesla just now is getting below the 200 moving average. So technical wise, it is now considered undervalued, but just because it's undervalued does not mean it will bounce. So if you go to a weekly, and again, I posted the picture on the main chat. If you go to a weekly, you'll see there the 169 level is also a previous high that we wicked off of around 2020, what is this, August? And it is a level we kind of hesitated near around in 2023 in April and in 2024 in April as well. So that is the level I personally will be looking at for Tesla to think, okay, this is a level I need to pay attention to. Because as I said, the level I was paying attention to was 252.86, 56. It didn't hold that. So I'm not, if a level I'm looking at that I knew was important didn't hold, I'm not actively trying to find where the next level is. I'll just look at where the next important level is and just keep it at that, right? Because again, here's the thing. If something were to have a strong bounce, if it were to, let's say the whole bear market were to be canceled tomorrow, hypothetically, you can wait for confirmation to enter into that bounce. You are not going to see Tesla If for some odd reason the bear market was canceled tomorrow, you're not going to see Tesla jump from 222 to 340. You're going to see it probably jump from 222 to 240 to 250 down to 240 up to 260 down to 230, and then it will be starting to consolidate around 240, 250, and then eventually start rallying. And around that range, when you see the consolidation, if it meets your criteria, such as creating higher lows, volume increase, all these things, holding above important level, holding above an important moving average crosses, as JP has stated. These could be factors where you could look at, maybe I want to start sizing into this position in a decent amount. So that is how you figure out, okay, this is where I want to enter. Because if you're just going to try to nitpick the bottom, even if it's a long-term account, like, you have to think about yourself. Yes, even if this account is for when you retire, maybe like 10 or 20 years down the line, you still want to have good entries. You still want to have smart entries. You don't want to be in a lot of pain. Just because, similar to what we talked about in I forgot which video, I think it was the bear market video or the risk management one. If God forbid we hit a recession and you need to pull money out of your long-term account for whatever reason, you don't want to have that long-term account in massive red, because then all that money that was in there is so far down and so skewed that the money that you're taking out is nothing compared to what you put in. So you have to realize that. You have to realize that these long-term accounts sometimes could be, if God forbid, if the scenario comes up, a safe haven for your cash where you had to pull out of it. So you have to realize, okay, for my long term, I just can't, even if I have the money to just keep on buying entries, I want to make sure I have money smartly invested into positions where if you need to withdraw money, you're not going to be screwed. This applies to 60. Wow, that was a lot of feedback. If this applies to 60K accounts, 100K accounts, 200K accounts, even $1 million accounts, you always want to make sure you're doing things smart. Whether you have a lot of money or a little money, does not matter. If you're going to do stuff dumb, your account's going to end up being dumb. So, yeah. All right, next question. JP, are you still here? JP? Okay. I think JP went to go take out his dog really quickly. So the question was, does JP think TLT will outperform the S&P 500? Inflation fear makes it drop. Now recession fear makes it rise. How does the two forces balance out? All right. Since JP's not here, I'm gonna bring up my chart of TLT and give my answer, and then when JP comes back on, he could give his answer. I'm on here.
I can take this one if you want me to. I was the one that showed JP this.
Okay, go ahead. You go ahead, Tom.
So can you just give me the short version of the question again? I'm pretty sure I know what it was. I just want to make sure.
Will the TLT outperform the S&P 500 because of inflation fear? And how does the two forces balance out?
So the answer to that is no. Only because the definition of inflation itself is, you have two definitions. You have consumer price inflation, which is prices, and then you have what we call monetary inflation. That's where you expand the money supply. In either of those two scenarios, you now have more dollars chasing the same amount of stuff. So due to inflation, goods get priced higher. It's during deflation where goods get priced lower. And so anytime you have an accelerating inflation, you will see goods go higher. You will see prices go higher. Now, if the economy is good, it'll probably be across the board for everything. If the economy is not good, that's where you have to get good at picking sectors. Now, if inflation comes down, you're probably going to see a repricing of goods lower across the board if the economy sucks. But if the economy is good and you have falling inflation, you then have to become a sector picker. And the reason why right now you just have everything dumping is because you have inflation basically flat, right? If you take the big drop and then the big rise in it from 5 years ago, and you look at where it is, it's basically smack dab in the middle, right? So the entire focus is on the economy, not really inflation itself. So if you're worried about the economy, you look at TLT. And if you're worried about inflation, you get rid of bonds and you get rid of your currency and you go to essentially stocks or assets. That's the short version.
Thanks, pretty good answer there. Are you walking again? I'll take that as a yes.
Yes. Yeah. Sorry, I just muted my phone.
Yeah, no worries.
Yeah. It's like 60 degrees out. So.
Yeah, it's pretty warm here too.
And I've been breathing recycled oxygen for 2 days.
Why you
That's
gotta...
not true.
Yeah.
That's not true. Not 2 days, but for a large amount of 2 days.
Yeah. Enjoy your walk, man. Oh, okay, yeah. Here's a good answer by Javi. So the person that asked about the 300 moving average, I would be looking at the SMAs on the higher time frames, weekly, monthly, versus adding one higher than the 200. That's a good answer. Thank you. Thank you, market mechanic. Do you think MSTR can fall to 198 and 169? I believe MSTR can drop to $20. But will that happen? I don't know. You know, there's cases you could say that it won't fall all the way down. But where do you see it going from here? Well, the realistic price point would be the high of the range of the previous consolidation, right? That's the easiest way you can figure out where the next target could be, because stocks generally, especially ones that have bases in consolidation, frequently like testing the previous consolidation points. We're seeing that right now. If you go over for Tesla, you'll see the same thing, right? We tried testing the previous consolidation point. We couldn't hold it. So now if you come to MSTR, and I'm going to go to the weekly, you'll see that this 179 area, does not have to be precise, but this 179 area is going to be the next area it's going to target. Why do I think there? Well, you got two indications. One, if you guys were here for VRVP, or if you watched the VRVP video, you'll see that we have a massive volume gap to the downside. Now, of course, some crypto news can come out and, you know, MSTR can completely rebound, absolutely. But another indication that it's most likely going to come down here is the fact that if you look at the weekly candles from the current price to 179, where is there really support? Support is formed with consolidation. There's no consolidation in these points. If I go onto a daily time frame, you could try to say, oh, you know, there's consolidation over here between 224. But my next question to you will be, okay, yeah, if it bounces off of this 224 area, do you think it's going to last long? And the answer is probably going to be no. So on the weekly, if we go here, again, 179 would be our next target. And then we'll try to figure out where's the low of this range. And if you actually see on my stream right now, the low of the range, the cursor, the left of the cursor, if you look all the way to the left, somewhat coincidentally lines up, well, but not actually coincidentally, lines up with the previous high, which is all the way at 109. So those are the two major levels I presume we're looking at, which is going to be 179 and 109, right around those two areas. Because what can happen is either it bounces off these two or it consolidates and it rallies afterwards. So, yeah.
Did you answer the question?
TLT?
Oh no, that just came in. No, Bob. Bob asked the question.
Wait, 1 second. Let me go down the list here. So, do you think it's worth a nibble now that Meta is below $600?
Where do you see that question?
In the live session chat, if you scroll up.
Oh, my bad.
Yeah, no worries. Even though Meta is due for a theoretical bounce to the upside, I don't. Do I think if I have a really big account and if I'm okay with risking 2% of my portfolio into a starting position of meta, yeah, I'll be fine with it. If I have a smaller account, like let's say a 50K long-term account, I would be cautious from doing that personally. Okay, yeah, so JP, did you answer this question? How do I protect my long-term portfolio, which consists mostly of tech equities? Thank you. I wanted to sell them at the dead cat bounce area. I'm on the same boat.
Honestly, I got to be careful with what I say here.
Yeah, none of this is
Um,
financial advice.
yeah, I got to be very careful about how I say this. I would not look at selling or exiting any positions unless you bought the highs. And if you bought the highs, then that means that you're in serious drawdown on your account. Um, I would look at either buying calls on the VIX, uh, which at this point you're a little late because the VIX I think is at 30. Maybe it goes to 50. I don't know. I didn't. My target on the VIX was 28.50 or 29.22. I can't remember. Um, you can always try to sell. You can always buy puts against your positions to protect your portfolio. There's a lot of different strategies that you can take into that you can utilize to not have to take an L. It all is going to be relevant on the size of your portfolio, how much money is in each position, and where we're at on the risk scale of your trade. If you bought Tesla at 220 and it's at 211, you're down $9 on the trade. I mean, if you're a long-term holder, $9 doesn't change your life, right? Um, I would need to have a better understanding of what it is that you're currently doing so I can give
Well,
you my
okay.
opinion.
Yeah, they
But
just
yeah,
basically say they did not buy the high, just thought I should take profit and buy it when it goes to a lower point.
no, but the question was Bob.
No,
It wasn't this guy.
Bob was re-asking a question that I unfortunately passed, which was asked by a guy named Gio. Tom,
What?
dude.
I can
What?
take this one if you want. I have a very simple answer for this
Yeah, go,
because
Bob.
I've been
Go.
there.
Yeah, go,
If
go, Tom.
if you're waiting for the dead cat bounce, what you're saying is I don't know where it will bounce at. So your strategy is hope.
Thank
And
you.
hope is not a strategy. So what I personally, I'm just gonna tell you what I've done in the past. If you think it'll come back someday later and you just don't feel like selling it for whatever reason, the premium will probably not be that great. Sell call options equal to the amount of shares you have, like on a relative basis, at the price you bought them for. And then that way, if the stock ever does bounce back to your break even, you collected whatever premium you did along the way. You probably don't break even, but you make some money back and you get some equity back and you can kind of wipe your hands and walk away and say it was better, better red than dead. That's what I've done in the past on a couple oops. Because if you're just hoping for a dead cat bounce, well, if you don't know where the bounce is, how do you know how high it's going to bounce? So now your strategy becomes hoping twice. And hope is not a strategy. It's a little piece of wisdom from some mistakes made.
Covered calls are great if you can apply them. Um,
Yeah, I mean, you
yeah.
definitely won't make all your money back. But if it were to bounce back, at least you'd get some equity value and, at least you're not totally, you're not as wrecked as you were before. And then you have something to learn from. So,
Yeah, no, absolutely. Selling covered calls, if you have the opportunity to do that, can also bring your cost basis down. Um, and even let's say you bought it at a low point, uh, it brings your cost basis down even lower, and it gives you some protection. The only downside to covered calls is, of course, if it goes above the strike that you sold, and by expiration you don't like roll over the contract or whatever, you will have to give up the shares at whatever strike price it is. But if you're fine with that, then it's also a great you know what's it called? Yeah, you know what I'm talking about. You typically
Actually, I do, Kevin. Oh,
yeah,
sorry. I just had something come to my mind. This is really important, by the way.
yeah.
With regards to dead cat bounces, is the reason why I call it hope and not a strategy is because if you knew where it bounced, you wouldn't be thinking about selling anyways, right? If you knew exactly it was going to bounce, you wouldn't sell the bounce. You would average way down at the bounce, and then you would then sell it as it went up. And that's why I described it as hope, not a strategy. I just wanted to clarify that really quick. That went through my head.
Yeah, no,
Sorry about
absolutely.
that.
No, you don't have to apologize. You typically sell covered calls at the highest, but if it drops your 10 to 50%, is it still safe to sell covered calls? Well, okay. And I think this will be our last question before we kind of end the session because I gotta go break my fast. The answer ultimately relies on what your goals are, and I'm sorry, but we can't mislead people, and we don't want to mislead you because your situation is probably different than mine. But I'll give you my opinion. So let's say, for example, one of my positions, I'm okay here. Okay, oh, this is great. I have currently a position in SoFi. My worst fill, actually, no, I won't even say my worst fill. I'm going to tell you my average. My average on SoFi is $14. I'm currently down 22% on this position. Now, selling covered calls can help reduce that, but then your next question is, wait, but if it's too far out of the money, you won't really regain that much. Well, me personally, the reason why I got into SoFi is I think it personally has long-term growth. So I'm not trying to exit these shares. I'm trying to hold it for a long term. So then when it comes to selling the covered calls, what I would do is I would be selling the strikes above my entry. And if I cannot sell the strikes above my entry, let's say it's just the stock is way too far down, even though I still can do that here on SoFi, I can try selling it a little bit below, but I won't like sell my entire position. So what I mean is, for example, I'm just say let's say you have 900 shares of SoFi and it's down at $10.92, which is at right now, and your average is $14.10. Out of the 900, what I could possibly be doing is selling 4 covered calls at the $13.50 or $13 strike, where the premiums are a little bit higher than $14 or $15, and I could recuperate a decent amount of my loss, even if it were to come up to that strike price. And also, you would want to, if you think there's going to be a lot more downside to a stock you're selling covered calls for, you don't necessarily want to be selling covered calls for an expiration that's not theoretically, what the hell? Sorry, Astaghfirullah. You don't want to be selling covered calls on a strike that's the same week or the next week. You typically want to look 30 days, around 30 days. Because then you, of course, receive more premium. And we've talked about in the past, the theta ramp starts at 45 days and gets very steep around 30 days. So to answer your question, if I were to do this, if I were to look at my SoFi position right now, if I'm going to the, again, this is going to be the last question we're answering. If I go to the SoFi option chain, remember my my average is 1410. If I go to let's say I don't have anything up on my screen. I'm just looking at here on my tablet. If I go to, for example, the April 11th expiration, I could see here that the $15 calls are only worth 20 cents, which is nothing, right? That's not much. Even if I sell 4 of them, that's just what, $80? So what I could typically do is if I'm okay with releasing some of my shares at break even or a little bit below break even, I could be selling, for example, the 13 calls for double the amount of premium as the 15, which is at 47 and 45. And if I think SoFi is going to even have more drawdown, I could sell the 12 or the 12 or 1250 calls. And the thing is, let's say it does reach that strike and you don't want to sell your stock, you can roll the contract before it happens, before it reaches that strike price. Or if it reaches that strike price, you can wait for near expiration, wait for any extrinsic value that's still left on the contract to seep out, and then you can roll it to another 30 days out. And you would just try to recuperate the premium you lost from buying out the contract. Hopefully that made sense. But that's what I would personally do. Again, all my opinions. All right, it's been a pleasure, JP. We're gonna wrap it up here because I do actually need to go break my fast.
Yeah, I'm fine with that. I'm gonna
Okay.
stop my stream here.
Cool. All right. Well, it's been great talking to you guys. We have to see if I need to see if I can do a stream on Thursday. I will be traveling to see my grandmother, and for my birthday on Thursday. My birthday's not on Thursday. Yeah. So no, wait. When am I? I'm going on a train. Yes, I picked the train over a plane because I'm not going on a plane after all what's been going on. Call me dumb, but I'm going on Wednesday on 12th, and it's an 18-hour train ride. So I don't know if I'm gonna be having the energy on Thursday. So
Hey, we can skip it on Thursday and push it to the weekend or something. I don't know.
yeah, we'll definitely see. Yeah, we'll keep you guys posted. But again, it's been a pleasure. Thank you, JP. Thank you, Tom. Both of you are speaking. Especially thank you, JP, for doing the whole thing about the sector rotation. All right. I'll see you
Perfect.
guys later. See you, JP. See you, Tom. See you
I'll
guys.
see you tomorrow, Tom. I'll give you a call in a bit. Okay.
All right. I just have one stupid thing to say though.
Yeah, what's up,
What?
Tom?
Why would you take a train? I've heard of, I mean, people just survived a plane crash where the plane went upside down in Minneapolis and Toronto. I've never heard about someone surviving a train crash.
Well,
I'm out of here. Goodbye.
well, cause I'm all alone. I get my space, 18 hours all to myself, without all the
Eh,
responsibilities. You know what I mean? I got a Wi-Fi. I could work, kind of. Read a
eh,
book. Do you read, Tom?
I feel like I've read everything that exists.
Oh, great. I've read a lot
I
of
don't
things,
know.
but I'm still trying to read books. Like, what's the book I have here? I think it was like The Art of something. It's not Art of the Deal by Trump. It's another. Yeah.
Oh, you mean where you propose a really stupid idea and the world goes into chaos and then you rescind a stupid idea and then you're right back to where you started and then people cheer it? Got it.
Yeah, basically, right. But yeah. All right. Well, all right. See you, Tom. See you guys.